We'll go ahead and get started here. Welcome to More Than Midwest, Solar and Wind Permitting Best Practices Across the U.S. We've got our panelists here, David Loomis, Bryan Loomis, and Tim Roberts, who will each be doing a presentation as part of our time here this morning, and then we'll be doing some question and answers at the end. To start us off, I thought I would share just a little bit about SER. If you're not already familiar with our company, we provide economic consulting services to developers of utility scale renewable energy projects across the US. We got our start here in the Midwest, but we can perform an economic impact analysis for projects in any state. And we do have experts that travel across the US to provide expertise on the economic impacts of these projects. We were started in 2013 by Dr. David Loomis, Professor Emeritus of Economics at Illinois State University, and now we've grown to a company of over 20 employees. We've got a group photo down there, and that's about half of our staff that were able to attend the Illinois Renewable Energy Conference, which SER hosted in the fall, and we plan to do that again this year. To date, we've performed over 400 economic impact analyses. And this next slide shows a breakdown of the states where we have experience. And again, we can perform an analysis for projects in any state of the US. We have experience in 36 states, and we've worked with 8 out of the top 10 developers of renewable energy projects in the US. This next slide is a new map that we've developed to show our experience in different RTOs and ISOs, various grid regions across the US. You can see the majority of our experience is in MISO. We've done 221 projects there, and then 78 in PJM. We also have experience in the Southeast with 37 projects there, and then in SPP, the Southwest, Northwest. So a good amount of experience in various regions. We've done a couple in CAISO and then a few in ERCOT and in New York as well. So hopefully this gives you an idea of just the scope of our company and our experience. As I said, we did start in the Midwest, but now we have experience all across the US. And we'll go ahead and get started with Dave's presentation. I'm going to read his bio here real quick so you get a sense of his experience and expertise. Dr. David G. Loomis is Emeritus Professor of Economics at Illinois State University and co-founder of the Center for Renewable Energy. Dr. Loomis has over 20 years of experience in energy analysis and has performed economic development analyses at the county, region, state, and national levels for many different energy projects and associated supply chains. Dr. Loomis has testified before the Public Utility Commissions in over 10 states, and he has also testified over 70 times before local county boards. Dr. Loomis is a widely recognized expert and has been quoted in the Wall Street Journal, Forbes magazine, Associated Press, and Chicago Tribune, as well as appearing on CNN. Dr. Loomis has published 40 peer-reviewed articles in leading energy policy and economics journals. Dr. Loomis has raised and managed over $8 million in grants and contracts from government, corporate, and foundation sources. Dr. Loomis received his PhD in economics from Temple University in 1995.
Thanks, Ethan, and welcome to our webinar. We really want to talk about the best practices for permitting renewable energy projects. And I think in looking over the list that I've been to at least 100 different permitting hearings, either as most of those as an expert witness, but several others just attending and seeing what goes on. And most often you have a list of expert witnesses, but they're discussing how to limit the harms that the public thinks are going to result from a renewable energy project. So that could vary between noise, shadow flicker, especially for wind projects, property values for both wind and solar projects, health impacts, fire, lightning strikes, visual impacts. And the experts are all lined up to say that the project conforms with whatever the ordinance says is the appropriate measure for limiting risk in that area, or to say that it's non-existent. It is something that the public maybe fears, but it's not borne out in the data. And these experts are all necessary and useful, but really their purpose is to give the public a reason not to oppose a project. And really, as a developer, what you really want to do is to give them a reason to want your project, to be in favor of your project, not just be neutral. Next slide. One of the things that we found that has been most useful is to talk about property tax and property tax revenues, but especially itemizing it down to the different taxing districts. So that gives lots of people lots of reasons to support your project. So it could be the county commissioners and looking at what's going to go into the county general fund, or it could be the road districts and the supervisors there, or the school superintendents that look at the large sum of money that will flow into the school district. I've even had librarians come up to me at permitting hearings and question the numbers and really would I get this? I had one librarian with tears in her eyes because of what that money was going to mean in terms of the things that she could do at the library that she never thought she could do. And she just stumbled into this hearing not knowing that it was really going to benefit the library and her passion. Next slide. Another area is obviously jobs, and everybody loves to talk about jobs and jobs that are created or supported. But this can really be a leverage point to talk with either state or local economic development officials. Typically, there's one person or sometimes an agency that's responsible in the local area for economic development initiatives. So if you can talk to them early on about what this project is going to mean in terms of investment, and especially to talk about the magnitude of jobs in the local area, local hiring, et cetera, they can be a big help in advocating for your project, because typically as that local person, they know all the different lay of the land, the different officials, and can help you navigate through that way. Typically what I find is developers will only talk about the direct impact. So these are things that are easy, or at least easier to quantify, because a developer can go to their EPC a contractor who's going to actually build the project and say, you know, what are the number of on-site construction workers that are going to be here? And then they'll have an estimate of the developers or the operators, so the solar technicians or the wind turbine technicians that'll be on site. And that's the number that they quote. And that really shortchanges the true economic impact of a project. Next slide. Really what we want to focus on, and the only way that you can really get this is to do an economic impact study, is to look at those indirect and induced impacts. And these are very large for renewable energy projects. So what is an indirect impact? An indirect impact is really looking at those supply chain impacts and saying what is the economic activity, what are the jobs that are created or supported as a result of your purchases of materials, of labor, and equipment. And we'll take great care to say how many of those purchases are going to take place in the local area versus the state versus somewhere else in the country or even internationally. But typically, a renewable energy project will generate millions of dollars in local spending when we look at just roads, road enhancements, road repairs after things are done, material purchases that are done in the local area, hotel and restaurant purchases due to workers, whether they be local workers or out of town workers that are going to work on the project, and all the contractors that you're going to have and subcontractors working on the project. So only counting those direct impacts really greatly diminishes the project's true value to a community. Next slide. We calculate both the state and the county results because as you're going to go to permitting, as you well know, depending on the state, the permitting is either done by a statewide body. In one case, New Mexico, there is a threshold, and anything above that threshold goes to the Public Regulatory Commission or the PUC in that state, or a siting board adjacent to that. But in some states, it's done at the county level or the township level. In Pennsylvania, I was involved in a solar permitting at the township level. And by quantifying both the impacts at the county level and the state level, it gives you that flexibility, because what I found is even at the state level, where it's a siting board or the Public Utility Commission, they really are concerned with the local area and the economic activity that will benefit that local area. But they most naturally will also look to those statewide impacts and kind of zoom out and say, what is this going to do for the state that we're looking at? So we give both of those figures, the county and the state, so that they can look at both of them and see what impact will come. This is me. I think this is the Kentucky Siting Board. You can see me up in the upper right. This was a virtual hearing that I was involved in. Next slide. And this is Bryan. Bryan's going to be speaking next, but this was an in-person hearing and was more recent. There's the Weirs Creek solar that was videotaped, and I pulled this off of YouTube. I'd say about 75% of our analyses don't require expert testimony. And so we'll write a report. These reports can be used not just for permitting hearings, but very early on to talk about to the various stakeholders when you're first introducing a project, to say, here is the magnitude of the economic impacts that will come to the local area. But in 25% of the cases, I think I have testified at well over 100 different hearings. It's important to have experts that can explain the results, explain the methodology, and be able to do that to a wide range of audience sophistication. So whether it be the general public that's just getting up and asking questions, whether it's zoning officials or county commissioners who have questions about that, or it's at the state level where it might be commission staff who have, advanced degrees in economics. I had one, hearing in Kentucky where the commissioner had her PhD in economics and asked me very detailed and technical questions that I never expected to come from a public utility commission commissioner. So it's important to make sure that you have a wide range of understanding and can explain those results. And it's also critically important for those experts to have understanding of renewable energy, not just the economic impacts, but how does renewable energy work? How does a project get built? What are the examples of what this money is going to be used for and spent in the local community? And that requires an intimate knowledge of wind, solar, and other renewable projects. With that, I'll turn it back to Ethan.
Thanks, Dave. Next up is Bryan. Bryan Loomis is our vice president. Since 2019, Bryan has performed or overseen over 200 wind and solar analyses at Strategic Economic Research and has also provided expert testimony for permitting hearings and open houses in many states, including Colorado, Kansas, Indiana, Illinois, and Iowa. Bryan's analysis expertise includes renewable energy property taxes, economic impacts, and land use. Bryan has done direct research for the tax codes of over 20 states, establishing procedures for the property tax team to conduct analyses in those states. Before working with SER, Bryan ran a consulting agency working with over 30 businesses on growth and marketing. Bryan received his MBA from Belmont University in 2016.
Thanks, Ethan. So my topic for today is going to be the local level permitting, so permitting at the county level. And as probably all of you know, a lot of these counties that are getting developed for wind or solar are quite small. They're rural, low populations, and these are getting built in rural areas outside of city boundaries. So it's important to realize the dynamics at play in these communities. It's easy to see when you go into a community what the formal hierarchy is that would have the power to approve your project, you know, the zoning board members, the county commissioners, the school district superintendents, and those people you certainly need to convince and get on board. It's also important to understand the cultural power structures that have been built up over time and how much influence community members can have in such a small and tight-knit community. So this cultural power has been earned over time, you know, over decades. And so for a developer to come into a community, you know, you can do things to build support, to have conversations with people and gain some level of trust. But comparing that to a community member who's lived in that community for decades and has been you know, a member for that long and has earned that trust over time, it's going to be very hard to gain that level of trust, even, you know, in, you know, a multi-year development process. So it's important not only to earn trust, but also to get people who have that existing cultural power and existing influence over the community on board. And so I love this graph showing that, you know, other than just a formal hierarchy, when we relate to each other just as humans, there are these informal webs of cultural influence that get built up over time and can really affect, you know, for a renewable energy project, whether it does get permitted or not, because these people have influence. The next thing I'd say about local permitting is there are going to be specific aspects of the community that could matter a great deal and could change how you present your argument. You know, the example that comes to mind is you know, when we're working in the Midwest and those, you know, core grain belt states of Illinois and Indiana, one of the, you know, we're often for solar, it's going to be built on land that had been used for agriculture. And so something that sometimes gets brought up at hearings is, well, where is that agricultural land going? Or this idea of we need agricultural land to feed the world. And so we'll show in some cases, you know, these statistics of where the crops that are grown commonly in these areas are going, being primarily to animal feed, biofuels, and that sort of thing. So that argument does play well in certain areas, but if you're in an area like Texas or Kansas, for example, where livestock farming is such a bigger piece of the economy, that might not be an argument that you want to put forward because they're seeing, oh, okay, soybeans are being grown here. That's going to animal feed. That's feeding a vital part of our economy, and we can't take that away. And so, knowing those facts about the state and the community that you're built in, I've been part of permitting hearings where radar and potential interference with radar was a big deal, and most areas and most developers would never think about that. And then have been in ones where the tourism industry was quite large, and the perceived impacts on the tourist industry took up a huge, chunk of that permitting hearing and the opposition. And so knowing those things about the locality that are going to come up in those hearings are really important. The last thing I'd say is at the local level, you never know what's going to come up, and you're never going to be able to prepare for everything that comes up in a hearing. The thing that you can do is we know, over time what the concerns are that legitimately need to be addressed and that people often have concerns about. And so we're going to, when we're a part of hearings, we want to cover those things that people really care about, the jobs and property taxes, have a team of subject matter experts available to address all areas that you as a developer might not have the deep expertise in, but those things, the handling the perceived negatives of the project and showing that those things. But there are going to be a wide variety of things that come up during a hearing, and you'll drive yourself crazy if you're trying to prepare for every single thing that's going to come up in these. But we've learned over time, and developers have learned over time, what are those things that are common to all projects that are legitimate concerns that we need to address through, the technology that we're using, the setbacks that we've built for the project, and those sorts of things to really address the community concerns. And so if you're prepared on those and are quick thinking on your feet on all of the rest, or defer to later covering in a post-hearing data request, then you'll do fine. So I'll turn it back to Ethan.
Thank you, Bryan. And I forgot to mention at the beginning, if you do have questions, feel free to leave those in the Q&A feature through Zoom, and we will address those at the end of everyone's presentation. Next up is Tim Roberts, who's our manager of data analysis. Timothy is an experienced professional specializing in renewable energy property tax analyses, having conducted over 250 comprehensive analyses since 2022 at Strategic Economic Research. With expertise in researching state tax codes, Timothy has developed templates and procedures that streamline property tax analyses for the team. Beyond tax analysis, Timothy has performed expert economic impact analyses and contributed to company-wide data management by creating programs and tools to enhance data acquisition and efficiency. Timothy's work also included calculating Strategic Economic Research's net carbon offset to date in 2023, which led to the receipt of a prestigious Renewable Energy Award from Google for SER. Tim, take it away.
All right. Thank you very much, Ethan. Now, today we're going to be talking about how property taxes work in non-Midwestern states. Given that I only have 15 minutes, I'll only be able to cover a few states today, but I'm going to be doing my best to draw connections to other non-Midwestern states. And if there's anything that I don't cover today that you'd like to hear more about, feel free to ask questions at the end or reach out, and we'd be happy to provide more information on anything that we don't cover. So getting started, we're first going to talk about why do we care about property taxes. Property taxes play a crucial role in the permitting phase of a project's development. At SCR, property tax analysis was once thought to be almost a secondary aspect, with the primary focus being placed more on economic impacts. However, over the years, we've seen a growing demand from developers nationwide who recognize that property tax data is just as key of an influential factor in securing a project's approval as typical economic data is. So as a result, this analysis has become an integral part of our approach. But why is it so important? Well, the size and circumstance of a renewable energy project significantly impacts its financial contribution to local communities. But on average, we typically see projects of a standard size can generate anywhere between $10 million to $50 million in tax revenue over a standard 30-year period of operation, with some on the higher end even exceeding $500 million over periods of like 50 years of operation. This revenue is then distributed across the various taxing districts, with the largest shares typically going to school districts, county funds, and essential community services like fire departments and libraries. So for counties that are focused on growth, economic impacts, and job creation at the permitting phase lay the foundation for growth. But property tax revenue serves as the lifeblood that sustains and nurtures that long-term community development and growth economically throughout the period of operation. And we're seeing developers and local governments recognize this more and more lately, hence the increased desire for property tax data. So how do property taxes work in non-Midwestern states? We're first going to be starting by taking a look at Texas. Now, Texas is a powerhouse in energy production. They lead the nation in renewable energy growth. And according to Berkeley Labs' wind market report from 2024, Texas installed more wind capacity than any other state in 2023, adding over 1,300 megawatts for a total of about 41,000 megawatts. And this same trend held true for solar as well. Texas added about 4,300 megawatts in 2023 across 21 projects. And this brought its total solar capacity to about 15,000. And that's the second highest solar capacity in the US. So with such rapid expansion, it's clear that Texas is a prime location for renewable energy development, but what can developers expect when it comes to building projects in Texas? So we're going to start by going over some of the basics. Texas doesn't impose any sort of replacement or generation tax for renewable energy. It's more of a it's based on ad valorem, which is basically it's based on its value. So Texas assesses their property based on market value, which is just the price that it would sell for under normal market conditions. And properties are generally assessed at 100% of their market value, and assessments typically consider the full cost of construction, so materials and labor, but it does exclude intangible costs. And for those of you who are unfamiliar with intangible costs, that's generally considered any of your property costs that are not physical. So things like permitting fees to the county, economic impact studies, your sales tax, contingency, things like that do not go towards the basis of taxation. In addition to that, in Texas, construction work in progress is taxable, and it's assessed based on its current level of completion as of January 1st. And in Texas, the determination of depreciation and percent good tables for property valuation is generally managed at the county level, but the Texas Comptroller's Office does publish annual business personal property depreciation schedules every March. So there are counties that have the authority to develop and implement their own tables to assess property values, but they might also use the states. So you'll see a little bit of variability in the localities there. There are also some minor differences between how the state handles solar and wind. With solar, the rules are very specific. There's very clear rules for how appraisers are to appraise the solar energy property. There's very clear rules for what method of appraisal there are and how to depreciate that property. For wind, on the other hand, it's a little bit more ambiguous. The Texas Code does not specify unique valuation methodologies or depreciation schedules or minimum taxable values. Instead, wind properties are generally appraised using what's called, standard procedures applicable to all normal property. So it's generally up to the appraiser's discretion. However, recent developments in Texas have caused several development firms and third-party appraisers to push for the valuation approach to be the standard, as it's considered to be more fair for both the developers and the counties. Now, going forward, we're going to be touching on what I consider to be the most important part of taxes in Texas, which is the Chapter 312 abatement. It's worth mentioning that the structure and some of the details of this abatement are going to be specific to Texas, but the way that it works can be applied to many different states. States like Mississippi have a fee in lieu of taxes that works similar, and Louisiana has the ITEP, which also works very similar. So I'll be talking about this in reference to Texas, but this is a structure of abatement that we do see in many other non-Midwestern states. So Chapter 312 is really interesting. It's an abatement that allows renewable energy projects to have an abatement on the portion of the increase in the property's appraised value resulting from the energy project, and it cannot exceed a period of 10 years. The important part about this abatement, though, is that the approval, duration, and specific terms of the tax abatements are all determined at the local government authority, such as the county or municipality where the project is situated. And to be eligible, the projects must be located within a designated reinvestment zone, and improvements have to contribute to economic development within the area. But the important part there is that the details of this abatement are negotiated at the county local level, which is very interesting because that means that there's a lot of variability between how this abatement ends up looking in reality. So a few examples of ways that we have seen this abatement go. In 2024, we saw a Texas wind project that had a 100% abatement limited specifically to county and county road districts. And that included a per megawatt payment to supplement those districts. And the other taxing districts were not part of that abatement. Additionally, in 2023, we saw a hybrid renewable energy project that saw a 70% abatement agreement for 10 years on all of the districts except for school districts. And then in 2022, we saw a wind project that had a maximum of a 50% abatement for 10 years, which was for very specific districts, with supplemental payments from the developer to the county included in the agreement. And this was all contingent on a requirement to create jobs as a result from this project. So as you can see, Chapter 312 abatements can go many different directions, and there are several pros and cons to that. It can help developers in a lot of ways, but it can also cause a lot of complications. It can help developers because it has customizable terms, because the agreements are negotiated at the local level, so developers can tailor this abatement to align with their project's needs. There's also lower upfront costs by reducing the property tax obligations in the early years of the project. And it also just generally attracts investment by making it easier to have projects built in that area. So, it makes it a competitive location for large-scale energy projects. On the flip side, though, that customizability is also difficult because there's uncertainty and variability. The terms might differ from county to municipality, meaning that developers have to navigate complex location-specific negotiations. Additionally, the approval process can be complicated because the agreements require local governmental approval, so projects can face delays or political challenges. And it's also a limited duration abatement. The tax abatements are only 10 years maximum, so developers do have to plan for the full tax burden once the agreement expires, impacting long-term project economics. So overall, the structure of an abatement like Chapter 312 that we can see in multiple states is an interesting abatement, but it's also a double-edged sword because it offers financial advantages, but it also requires careful negotiation and long-term planning. Next, we're going to be touching on Florida. Now, Florida operates very similarly to Texas in that it is also an ad valorem tax basis, so that the taxes are based on the value of the project again. Now, Florida currently has no installed wind projects. It does, however, have a cumulative solar capacity of over 7,700 megawatts, with over 1,800 of that installed in 2023. And this makes Florida the third largest solar energy producer in the United States. So the basics of taxation in Florida, a majority of the costs of the project are considered tangible personal property, and installation costs are included for taxation purposes. Property depreciation is generally laid out very clearly. It's depreciated according to the Florida Department of Revenue life expectancy guidelines. But some counties do elect to have their own depreciation and trending tables, and some elect to use the state's provided depreciation and trending tables. So similar to Texas, we have a little bit of variability in how some projects might be depreciated and handled at the assessment level. Now, for abatements in Florida, this is a better example of how most state abatements work. The details are specific to Florida, but the rigid nature of this abatement is how we see most of them turn out. So in Florida, 80% of a renewable energy source's device cost is exempt from property taxes, and this includes costs related to solar panel equipment, but not things like the substation, transmission line, labor, or real property improvements. And in addition to that, the first 25,000 of tangible personal property is exempt from property taxes. So this is an example of an abatement that there's no negotiation. The state very clearly lays out what you can expect as a developer. And it, of course, also has its own pros and cons. There's lower upfront costs for developers. There's an 80% exemption, which reduces the tax burden on renewable energy projects, making the investment more financially viable. It encourages renewable energy growth by making solar and other renewable installations more cost effective. You get tangible personal property tax relief in the form of $25,000 off of your project, which can especially help smaller companies trying to get into the renewable energy field. And there's generally just long-term economic benefits from the reduced tax burdens on the renewable energy project, which can lead to job creation, local investment, and all the things that we love to talk about at SER. So this is just another example of the more rigid nature that we typically see with abatements that don't look like Chapter 312. For our last state, we're going to be talking about Colorado. Now, what's different about Colorado compared to Texas and Florida is that, as I mentioned, Texas and Florida are ad valorem tax basis, so they're based on the value of the project. Colorado is more of a capacity formula based basis of taxation. This is something that we see in many states like Illinois, Nebraska, South Dakota, North Dakota. These are all states that are formula based. So quick stats on Colorado using Berkeley Labs wind market report and solar report again. Colorado has about 200 megawatts installed in 2023 for wind, resulting in a total of 5,300 megawatts. And for solar, Colorado added about 700 megawatts across 5 projects in 2023, which brought its solar total to about 1,800, which keeps it in the top 10 in the US, but just at number 9 in terms of solar production. Now, renewable energy projects in Colorado, the way that the formula works is that as long as they have 2 megawatts or more of capacity, they get assessed using the statewide formula. And this assessment method is used for both real and personal property used to generate electricity. So the Division of Property Taxation in Colorado publishes threshold rates annually that are then multiplied by the nameplate capacity of the project to arrive at the generation property value. And then a fixed rate of 70,000 for the intertie line is added to the generation property value to reach a total property value. Colorado also accounts for depreciation, straight line 5% annually down to a minimum of 20, but then levelizes those costs by averaging the assessed value over a 30-year time span. Like any other situation, this has pros and cons to it. There is statewide consistency. So you have a standardized formula that ensures uniform tax treatment for all projects. And it also reduces the uncertainty for developers. You have predictable tax liability. So the set formula and levelized cost over 30 years, you can better forecast your long-term financial obligations. And the depreciation consideration acknowledges the asset devaluation while preventing overtaxation of aging infrastructure. In addition to that, the fixed intertie line simplifies the cost estimation for transmission infrastructure. On the flip side, though, it may not always reflect the true market value because a formula-based approach might not accurately capture the actual market value of the individual projects, leading to potential over or under taxation. And depending on where you fall in that line, that might be a pro or a con for you. Additionally, there is limited flexibility for local governments since the assessment rates are set at the state level, so the local taxing authorities have less control over the tax revenue adjustments. And finally, the depreciation levelization can reduce early savings. While the formula accounts for depreciation, levelizing the assessed value over 30 years could result in higher tax liabilities depending on how your power purchase agreement is set up. That's sort of unique to the individual project there. Finally, I'd like to discuss a few general trends in the renewable energy property tax industry. I'd first like to talk about the investment tax credit and the production tax credit. I'm sure all of you are very, very familiar with this credit, so I won't spend too much time explaining it, but for those who are not, there's a little bit of information about it on the slide there. What I'd mainly like to talk about is the challenges that ITC and PTC can bring to the property taxes of a renewable energy project. There's a lot of policy uncertainty around these. We've seen them change many different ways with extensions, phase downs, eligibility changes, and each state has different rules for how these credits impact property taxes and local incentives. It's overall just a very uncertain issue. States like New Mexico and Arizona have it written into their code that they can reduce their property taxes by the amount of the ITC. Other states, it is a lot less clear, and sometimes it's not always clear how that's going to be practiced when it's there in reality. And so oftentimes the burden of discovery can fall to the developers, the localities, the people working on it to figure out how it works. So in general, the ITC and PTC credit, we really want to see more clarity from individual states on how it affects property taxes because that will just benefit everyone in the industry. Lastly, I'd like to briefly talk about battery energy storage systems, specifically standalone battery energy storage systems. I think we're all aware of how important BESS can be to furthering the renewable energy industry. But from a property tax standpoint, standalone BESS can be quite challenging. State level policies vary widely, which impacts how it's classified for incentives, interconnection rules, and grid participation. There's also a lack of clear standards for energy storage deployment, which can slow down approvals. And some states don't have clear property tax exemptions or abatements for standalone BESS projects. We've seen plenty of projects where a BESS is co-located with some other type of energy source, and generally it's quite clear that they qualify for abatements that would also qualify for solar or wind. But when BESS is on its own, it can be a lot more ambiguous, and a lot of states either have no information on it or very unclear information. And so the importance of standalone BESS in furthering this industry is very important, and it's our job in the industry to continue pushing our lawmakers and local governments to consider standalone BESS legislature and get more of that written into stone. And the recent expansion of the investment tax credit is a great example because it now includes standalone BESS rather than requiring it to be paired. That's a major step forward, but we still want to see those kinds of changes at the state level. So now I think we are ready for the Q&A portion.
Thank you, Chris, or thank you, Tim. Let's see. I'm just going to share a little bit more, and then we will move into our Q&A. All right. So just a little bit more about SER and how, if you're interested in working with us, how you might go about that. So our experience, as has been already shared from the previous presentations, we have experience in economic impact analyses, property tax and land use analysis for wind, solar, standalone battery storage. We've done some studies for transmission lines, some hydrogen projects, and also natural gas. And our reports really highlight the job creation, both during construction and operations of the project, the earnings from those jobs, the economic output, and then the property taxes. So our deliverable is typically a 30 to 45-page comprehensive report that'll detail out the local county economic conditions, provide some context around the growth of solar or wind or whatever the technology is, the growth of that within the state and the US. And then we'll also break out the property taxes into kind of those full tables of year by year amounts going to the various taxing entities. So here's just a quick quote that we received from someone that we worked with recently. We've really had the pleasure of working with so many developers across the industry that are moving the needle in the deployment of renewable energy projects across the US, which has been great to see. If you are interested in working with us, you have a project that might need an economic impact analysis, we would be happy to speak with you about that. And as Dave said, these reports can be used for permitting, but also earlier in the project's development, really as you're first going into the community to talk about the development. If you want to share some economic impact numbers, just some high level impacts, we can produce a shorter report if your project is at an earlier stage in development. So happy to talk through whatever project you might have that would need a study, and we can talk about what that would look like for you. So you can reach out to me at my email address, or we've got a contact us page on our website, and there's more information about our company there at strategiceconomic.com. Finally, we will move into our Q&A portion. So I'll have the panelists turn their video back on, and let me take a look at what questions we've had here. I'll let Dave or Bryan tackle this first one that we received. It was anonymous. This person said, Have you handled cases of projects where the BZA asked for more requirements than those set out in the ordinance that were unrealistic and unfeasible, and how did they handle it?
Yeah, I have seen that happen. It has not happened so much on the economic impacts or property taxes, because I feel like it's in fair game to say, how were these calculated? What was the methodology? How reliable can we be of these estimates? But sometimes they'll go above and beyond and ask questions that are well outside the scope of the ordinance and the things that are handled. And in most cases, to the extent that it's possible and you have expertise that can address that question, even if it's not within the ordinance, people will go ahead and try and answer that to the best of their ability. If it's really unrealistic or outside the bounds of the ordinance or the project, I think it is good, and I've seen it well explained to say, that's really not part of the discussion in the ordinance here, and kind of limit it to the focus. Sometimes they'll go down asking about federal policy, like we were just talking about with the ITC and PTC, and want to debate on subsidies and federal policy and so forth. And that really isn't productive or the focus of a permitting hearing at the local level. So to the extent that you could quickly address something and then move on, I've seen that handled quite well.
Great. Thanks, Dave. I do see a question about sharing the slide deck. We will, oh, and I'm getting a message that I'm still spotlit, so I'll turn that off shortly here. Someone asked if we could share the slide deck. We're recording this session, so we'll be posting the recording online afterwards, and that'll be sent out to all attendees. So we'll be sharing the information that way. So please look for that here in the next day or so. Let's see. There's one person that asked, do you have similar analysis on property taxes for other states? Tim, maybe you could speak to that.
Yeah, absolutely. I sort of went into minimal detail today based on the time restraint, but we can go into more detail on any state you would like to learn about it, especially if it's a state we haven't done yet. We'd be very excited about that. So if there's any information on specific states that you would like to know about, you can reach out to us and we'd love to give you detailed analyses and any information that you would need about them.
Great. Thanks, Tim. And maybe Bryan or Tim, if you want to speak to this, Alex Breckel asks, do you see some types of tax regimes generating more local public and permitting official support for clean energy than other tax policies?
Yeah, Bryan might be able to speak to this a little bit more than I can, but generally, I would think that whatever tax structure is going to bring a locality the most money would probably be the most favored.
Yes.
That's going to differ from state to state. So if you're a developer considering, which state to build in and considering the public approval of that, you might consider which one is generally going to bring in the most property tax revenue for the county. But I don't have as much experience in the permitting hearings, hearing some of that county feedback. So others might be able to speak to that a bit more than I can.
We're not real involved with the local politics that play in tax policy, but generally I'd say what I've seen plays better is those types of generation or replacement taxes, nameplate capacity taxes, like the ones that Tim showed in Colorado, where it's clear that the energy generated by the project or the actual production of the project is leading to property taxes. Those generally play pretty well. The tricky thing with value for solar and wind projects and so on is it's really hard to compare with equipment costs going down and advances in technology and such, it can be really hard to nail down like what is an actual fair market value for project. How should you depreciate it? I mean, the variation between states and how you depreciate projects or battery storage or any of the technologies that we're looking at, it can be a pretty wide variance, and they might use comparable what they would see as comparable equipment, but isn't really, the value doesn't work quite the same way in our opinion as it does for renewable energy. So, and the abatements I think are perceived somewhat negatively locally, whereas if it's a replacement tax, a generation tax that you can show, hey, we're trying to get to the actual value that's being produced here in terms of energy generation, and taxing based on that rather than cost, which can be somewhat of a moving target, particularly for new technologies. I've found that plays a little bit better. So that's, I think, the best answer that I can give for that. It was a really good question.
Absolutely. Dave, maybe you can speak to this, just given your extensive experience in the state of Illinois. An anonymous attendee asked, how can developers navigate the continuing difficulty in Illinois with pushback from jurisdictions, counties not abiding by the state statute and being more restrictive, et cetera?
Yeah, it really goes to a legal question, and I've seen a number of counties where the county board or the board president will, flat out say, "I wouldn't approve this project, but for the statewide permitting law, I really have to because they pass the statewide standards for permitting." I've seen a case where the county denied a permit that, in my opinion, should have been qualified. The county gave no reason for denying the permit. They didn't say what standard the project did not meet. And I believe that the developer threatened to sue the county, and the next county board meeting, they reversed themselves and approved the project. And so I think sometimes the threat of a lawsuit will be enough without actually having to engage in the messy behavior of suing a county. Just the threat of it may be enough to push it over the edge, or to say, you weren't specific on what we didn't pass. What didn't we? What in your ordinance did we not qualify for? And that will be enough to push them over the edge and say, well, I guess I have to approve this.
Great. Excuse me. Next question here is from Cal Brown. And Cal asks, how does cash flow valuation for taxes work for standalone BESS, given that the revenue stack values can be very uncertain? Who the heck knows what capacity rights will be worth in a decade plus? Is this just negotiated? I'll open that up to anyone who wants to take a stab at it.
Well, I'm the only one who's unmuted, so I'll try to handle that. So, battery storage, yeah, it does depend on the state whether you'd be taxing according to cost, or if it's more of a fair market value that could be a mix of indicators of value where you would potentially want to take cash flow valuation into account. Our position at SER doing forecasting and looking out into the future has been, for this very reason, the uncertainty about income or capacity rights and all of that is it's not worth doing an income indicator of value, particularly when you're forecasting potentially decades into the future. So we're really looking at cost, and we've found, like Tim mentioned, in Texas, a lot of assessors have chosen to do something similar for valuation, where they're really basing it on a cost and depreciation basis. But yeah, there are a lot of complexities there, and that makes forecasting very difficult. But we typically just look at cost in those circumstances. Really, what you're trying to do from a forecasting perspective, and our goal is communicating these things to the county. You're just trying to give them an order of magnitude of the property taxes that they could expect from a multi-million-dollar project. And so giving them, you know, and making clear what your assumptions were, that property taxes are going to work differently in actuality than in a forecast, but we're trying to give them an idea of the magnitude of property taxes that they could expect is really the best we can do from a forecasting perspective, you know, in advance.
Sorry, I was on mute. We've got a question from Justin Mason, who asks, can you please speak to the importance of courting local organizations for social license to operate, and why engaging in cultural community interactions are vital?
Yeah, I can take that. I think it is talking with local stakeholders and the local organizations is important to say I'm going to be a good community citizen, participate in the project. We've done numerous analyses where the wind or solar project becomes the largest taxpayer in the county by far, and makes up a good portion of that. And I've seen many developers that will contribute to nonprofits in the local community, not just to they'll be accused of buying votes for their approval, but the consistency that I see in that, and the involvement in local events that bring the community together, that will do that, I think are very important, because it shows that it's and oftentimes developers are coming from outside the state, and so they'll be met with some skepticism if they're not from the local community. So being involved in the fabric of that local community is very important, but hard to do. I recognize that that's hard to get to those events, and I know a lot of developers and those that are doing community outreach and engagement spend a lot of time in the community and going to events and supporting those things. So it's very labor intensive, but I think it's really important.
Well, the last question here is anonymous, but it's a really good one. This person asks, how do you advise that we get communities to trust your economic impact reports? I hear sometimes in public hearings that they don't believe the reports. This could be for any multitude of reasons. Maybe they were skeptical that you're Illinois-based, or they think you're not accounting for farming jobs lost. And we do get this question a lot, of just how to kind of reinforce the fact that we put great care and attention into modeling the results, and how to explain this complex subject in a way that resonates with the local community. Any of our panelists want to take a stab? Otherwise, I can speak to that a little bit. But Dave, Bryan, Tim.
Well, I'll start us off. I'm sure others will have more to say, but one thing that I've found plays well is sharing that the data that we're looking at for economic impacts is local data. You know, the software that we use finds the local industries and takes those into account when it's calculating the jobs and income and economic output. It's looking specifically at their local community. If an industry is not supported in that local industry, it won't place those jobs there. It'll look elsewhere. And so even if we are not locally based, we're based in Illinois, we can show that we did use that local data to produce their report and look at their community and take their local economy into account. So that's the first thing that comes to mind for me.
Yeah, I think you hit it well. We are looking at data that's specific to that local area. We use industry standard software. The Implan software is used not just in renewable energy, but it's used by economic development personnel across the country to say, oh, we're going to build a new hospital. What's the economic impact of a new hospital? I've seen lots of universities will use Implan to say what's the economic impact of the university to the local community. And so if you're dealing with economic development, the best way I know is if you can deal with the economic development person who understands studies like this and can get the local person on board. And I'm happy to have conversations with them to say, here's our methodology, here's our assumption, here's how we did the analysis. Then the local community trusts that person, understands that person. And if we can get that person to give us the stamp of approval on the study to say, yep, they did it, in a rigorous way. We understand it. We've done kind of our due diligence and their numbers are correct. Same way with property taxes. I've had numerous conversations with county assessors. And so if we can just run through our assumptions and methodologies and things with the local assessor, then the county assessor, everybody trusts the county assessor. They're the numbers person. And if the county assessor gets up in the permitting hearing and says, yep, these are the right, it's always subject to the assumptions put in, but I verified the numbers and they're, I certify it. So you're getting those local experts to endorse the work. And it is funny, even though I'm here in Illinois, even as we're talking, Tim is based out of St. Louis. Bryan's in Knoxville, Tennessee. We have employees in Colorado and Wisconsin and Florida and all over the place. So even though we're headquartered and started here in Bloomington Normal, Central Illinois, we now, as we've grown, acquired employees kind of nationwide. And so I think we're viewed as an Illinois company, but we do have employees and have had experience in lots of those other states. The final thing in terms of the counting for farm jobs lost, we can do that. In fact, we are looking to do our land use analysis. We're going to do a whole very greatly expanded report that'll look at land use, and it will account for the farming jobs loss and the net impacts during operations of a project. And so we can address that concern as well. But we do have in our appendix, here's all the jobs and occupations and things. I think people only think of the construction jobs and they don't think of all the other occupations that go into building a project.
Yeah, stay tuned for future webinars on that expansion to the land use, because I have a feeling we're going to be covering it in detail soon.
Yes, I was just about to mention we do have a webinar schedule that we are putting together as we speak. So we'll be doing hopefully monthly webinars here throughout the year. So feel free to check your email inboxes. We'll be sending out information about those future webinars and topics. But the land use analysis will be one piece that we'll feature. I do see one last question here just about a recording of the meeting that will be shared out here in the next day or so. Once we have that ready, we'll put it up on our YouTube page, but also we'll send out a link to all attendees so you can watch through this presentation again or share it with your colleagues. And yeah, I believe that is it. So thank you all for staying a little past noon here. Have a good rest of your Thursday. Thanks so much for joining. And again, if you have projects that need an economic impact study, please feel free to reach out to me. Thanks so much. Have a good one.